Challenges are working, trading, no nonsense.
GM. Warriors. Weekend workshop. Let's fucking go. How are we all? Good? Fan-fucking-tastic. Alright. Gather round, get in. Have I got a fucking stream for you today? All about false breakouts, swing failures, the difference in them, the similarities, what you can do, how you can identify them, how you can trade them, a whole lot of good stuff. So GM, everyone. Sound good? Sound okay? You can see the screen. We're all good, yeah? We're all good. Perfect. The link is in live questions, as always. If you're new, if this is your first stream, are you in for a fucking treat? This is Weekend Workshop. Traders, especially in crypto, have a tendency to either gamble all their money away on the weekend or do nothing. And obviously you want to avoid both of those, because generally there is not much to trade on a weekend, generally, and it can quite often lead to overtrading and bad decisions if you try to force trades on a weekend. So when people realize that and you say don't trade weekends, then they think, oh right, well, I'll just do nothing. No, don't do that either. The weekends are a time to get ahead, reviewing, learning, testing, building, all the hard work that goes on behind the scenes. And that's why we do Weekend Workshop. Saturdays, if you don't catch it live, you have 24 hours to watch it on a replay, and then it's gone. You'll notice that this is Weekend Workshop number 8, and number 1 to 7 are nowhere to be seen. Alright, so questions during the stream. If they're about false breakouts, put them into live questions. Otherwise, I will skip them. Tom got fired yesterday. This gives me an opportunity to deep dive consultancy and technology. Use it. Analyze what happened, right? Analyze what happened. Were you at fault? Where were you at fault? Take complete ownership of it. Take the lesson. If there's behaviors you need to change those behaviors and use it. Take the positive from it, which you're trying to do. Good. You're talking about opportunity, not feeling sorry for yourself, and use it to fuel you further. Good man. All right. Alfan. I touch on this a little bit in the lesson I'm about to do. We've moved on to bacon in coffee. All right. That's so fucking G. All right. Why did they disappear in 24 hours? This shit is golden. Exactly. Rewarding the weekend warriors only. Felfiat GM. All right. So, if you questions specifically about false breakouts, swing failure patterns, all that good stuff, drop them in here in live questions. And otherwise, let's get going. All right. So, and set here. We're all good. Let's fucking do it. So GM. This weekend workshop on false breakouts is going to cover everything you could want to know about them, some commonly asked questions, and how, most importantly, how to actually use them to trade. And then I'll answer your questions. This is one of those workshops where I expect some good questions to expand on, because the actual concept of false breakout is really simple. false breakout, also known as swing failure pattern, depending on the context. But really, it's just where price tries to break out and fails, right? It can look like any one of these. I'll come on to these in a moment. But really, it's just any time the price tries to go above and fails, or tries to go below and fails, and it can form in many different ways. It's an attempt to break away from some kind of balance or swing level and failing to do so. So, GM. First of all, terminology and a bit of a rant about semantics. It doesn't matter what you call something, right? Whatever works for you. When I say false breakout, you'll hear me use it as a catch-all term. So any time that the market tries to break out and doesn't, I'll say it's a false breakout. That could be something like a wick failure. It could be a swing failure pattern, SFP. It could be multi-candle. These are the three broad categories and the way I would define false breakouts, right? The reason why this is a wick failure, not an SFP, will be shown when I go to the full chart. But, there are other ways, I guess, if you really wanted to get anal about it, that this could form. But if you just focus on a swing failure pattern, which is an attempt to break out below or above a key swing level, that's important. It must be a market structure swing level on that time frame. A wick failure is just an attempt to break out above any previous high or below any previous low that closes with a wick above or a wick below. And then multi-candle, this is the one that most people probably get confused with and I get the most questions about, because initially a key feature of a multi-candle false breakout is that it actually has a valid breakout first. So if you're just following market structure rules about a break of structure, a BOS, you would see that. BOS, but then you have multiple candles and then it falls back inside and of course it's a failed breakout. I'll talk a little bit about these just kind of as a side note. Something like this, where you do see a multi-candle false breakout where it breaks higher. And actually I'll do it on the chart. First of all, note, here's an important note. A swing failure pattern or a wick failure, only those two, are stronger, air quotes, when resulting in a reversal candle. So what that means is, this swing failure pattern would actually be stronger if the candle closed green. Now, of course, it was a very big candle. It still is a valid SFP. SFP just has to go below the swing low and close the candle above it with a wick below. But up here, we see the wick failure. The fact that it tries to go higher and closes with a red candle would indicate more weakness. If that had closed like this one just 2 candles before, which also was a false breakout, wick failure, but closed neutral and sometimes could close green, you'll notice that they have a higher tendency to fail, meaning that one did not result in the move down. We had another push first before moving down. That's something to keep in mind when you're testing. If you're testing single candle false breakouts, whether it's swing failure patterns or wick failure, which again, I'm going to explain the difference in them right now. You should also split your testing into 2 or maybe 3 parts. One, where the wick failure results in a reversal candle, which is a red candle if it's on the upside. So if it fails to break out to the upside and there's a red candle close with a wick, versus if it tries to break out to the upside but closes with a green candle, still with a wick, still a failure. And you could add a third in optionally, which would be like a doji, where it opens and closes around the same level. And you can compare the data on those. And the question you're trying to answer is a wick failure more likely to have follow through, meaning a reversal, if it is a reversal candle, if it does not result in a reversal candle, or if it results in a doji candle? That would be like one way you could further enhance your testing. Because again, a false breakout is a false breakout. Anytime it tries to go above or below and comes back inside, it's a false breakout. But by defining different ones, you can hopefully find more edge. Not all breakouts are created equal. Not all false breakouts are created equal. Similarly, this type of move here, which I'll now go over onto the chart for, this type of move here, we have a multi-candle false breakout. It looks and feels, and for all intents and purposes, is a valid breakout at this time. So when this happens, you're all excited. Everyone's like, holy shit, we just moved up, we consolidated, we had a nice order block, we compressed near the highs, we break out, like this looks great. This should definitely go higher. Of course it doesn't. You play it on and we end up with a false breakout. One of the things that you should keep in mind is trend direction, right? So again, higher time frame context is important. Or not even higher time frame. It doesn't matter if this is a daily. You know the story, right? Markets are fractal. It doesn't matter if this is a 5-minute chart or a daily chart. Principle is the same. But here you can see that we were previously in a downtrend, quite a significant one. There was a significant area of supply here. This is like a daily bearish order block, this green candle, and then a strong breakdown. So not only was this breakout against the trend, because the trend was down, right? We'd made a high to a lower low, but the breakout was also into an area of clear resistance, which would make this multi-candle breakout, false breakout, more likely to happen. So how should you actually approach this? If you see this, right, when this candle is in the process of breaking out here, the first thing you'd be waiting for is, does it close back below this level? Does it close back below here to create a wick failure? If it doesn't, then you want to look at the next sign, so you're not just randomly aping in long and trusting every move. You say, okay, where are we in the higher time frame context? We are still in a downtrend moving into a retest of previous resistance. So the odds of this failing and having the false breakout that we saw are higher than if it happened up here, right? So if you imagine that this exact same move, which I actually can, I guess I can do this. If you imagine that this exact same move happened, except it was above the most recent. Oh, fucking hell, man. Give me the bars pattern. Here we go. If you imagine that exact same move happened, but it happened up here, okay, where the market was consolidating below resistance, and then the breakout took us into no resistance overhead, into a clean breakout with a trend shift, right, because it's now reclaimed that level, that's much more likely to have continuation rather than false breakout. You understand? Because what's happening here from a psychological perspective is people see what looks like a bullish move. It's a break of structure. It's a breakout. Yes. We've made a low. We've made a high. We've made a higher low. We've made a higher high. Yes. But we're still in resistance. We're still technically in a downtrend. Lows, highs to lower high to lower low to lower high, right? All of that. And so it's more likely to fail. When I say more likely, what do? Test it. Compare break of structures in a counter trend rally versus in a confirmed rally. What does that look like? All right. I want you, if you want to go deeper on this, I'm just going to use both examples in an uptrend. So one of the things I want you to look out for is when the market's already been going down, okay, and we have resistance above, and then we start to bounce, and then you see a breakout like this, okay, just like the one I showed. Compare that where it's going up through levels of resistance and it does have a valid breakout. So this is a valid breakout. How could you tell if this was going to be a potentially false breakout or not? Well, a good thing to test would be how often do these confirmed breakouts, right? This is a confirmed breakout because you're talking multi-candles before it becomes invalidated. How often do these type of breakouts fail versus when the market is actually in a confirmed trend, which would look something like this, right? Let's say it moves down, then it reverses. We have consolidation, we move up, we're already above resistance, and then you have a breakout there, okay? So the difference in these two charts, of course, is that chart B, the blue one, is already in an uptrend. There's no significant overhead resistance. It's had its downtrend and it's trending higher, okay, towards some level above. Maybe it's at all-time high, maybe it's not. It doesn't have to be at all-time high. It could also just be significantly in a confirmed uptrend, right? So again, that might be a bit confusing, so I'll show you. All of this, right, from this consolidation, when it broke out, all of this is an uptrend. Uptrend, uptrend, dip back, then we reclaim, uptrend. This is all an uptrend, okay? Why? Because it's making higher highs and higher lows all the way. Higher highs, higher lows on a high time frame. But if you zoom out and go across here, you'll be like, no, but there's loads of resistance. It's like, yes, there can still be resistance. Not every chart has to be at all-time high all the time, but you have a confirmed uptrend. Multiple higher highs and higher lows on whatever time frame, multiple higher highs and higher lows in a trending structure, making BOS after BOS after BOS is a trend, right? In simple terms. And the reason why this one is not is because it is not doing that. It is coming off a downtrend where the highs lead to lows, the lower highs lead to lower lows. And so until this breaks above 70, it would not be considered an uptrend again yet by that logic. And so even though it's making a, let me call it an uptrend within a downtrend, does that make sense? You're moving down, but you're making a low time frame uptrend to try and break that structure. They're more likely to fail. Why? Because people want to be bullish when the market moves up. But if the market's moving up and not yet in a confirmed uptrend, there's a higher probability of failure. Right? Hopefully that makes sense. So that was kind of a side note. Now back over here. And get out of that. I want to now explain why this is a wick failure and why it's not a swing failure pattern. The reason being is because it has not tried to break out from the most recent significant swing level, which would be there. A swing failure pattern must attempt to break above a significant previous level. So if you're looking at a downtrend, like we were in, you have a lower high and you have a lower low. So in the context of what Bitcoin was doing here on the daily chart, these are your two daily swing levels. So if it tries to break out above there and fails, that's an SFP. That's why when it tried to break to the downside and failed, that was an SFP, because it went below the lowest low in the recent swing and failed. This was a failure of its intermediate trend. So the trend that it was having on a lower time frame, this was a false breakout of that level. So it's definitely still a false breakout. It's just not a swing failure pattern because the actual swing level is above. Make sense? Cool. If it doesn't make sense, drop a question in. So that also explains what a swing failure pattern is, right? Swing failure pattern must be at an extreme. That would be how I would use it in terms of differentiating it just from any regular old false breakout. Why? Why does that even matter? Well, because you can have false breakouts all over the place if you don't define them, right? If you don't, this is for your own systems. If you don't create some methodology for defining what a swing failure pattern is, so it should be the most significant, then everything could be one. I mean, this candle here, right? This one, 11th of July, goes above that one. Is that a swing failure pattern? No. Because it's not at a swing level. It's not gone below the swing low or, as I said, the swing high, right? In between these levels, if you want to break them into sub-trends, you can, which would mean you could class this as a swing high if you want to, which would be totally fine. Again, it's personal preference, up to you. That was the highest point before the lowest point. So if price came up to here and did a false breakout with a wick, you could call that a swing failure. And you can also call this a swing failure, right? Your extremes, your biggest, highest time frame market structure levels are your most important. So that would always be an SFP if it went to there. This could also be classed as one. It's not going to have as high of a success rate because it can often wick above there and come back below and still be part of the breaking of structure, but test it. And again, I'll kind of revert back. Semantics, don't get caught up with what you're calling these things. I don't care what you call them, whatever works for you. The only reason to even give names to things is not to make it sound cool. It's not to fucking sell courses like many dickheads on TikTok do. The names should only be used to help you make sense of things. So if you just want to call everything a false breakout and that's it, fine. If that works for you, do that. If you want to differentiate SFP as being more of a more significant false breakout, do that. If you want to call these wick failures, do that. I don't call them wick failures, right? If that happened, I would call it a false breakout. This is like what I was saying before. If you see me talking in trading analysis or whatever on daily levels, I'll often just call pretty much everything a false breakout. And the purpose of this lesson is to break down the different types and show how you can trade them. So you've got your wick failure, which for me is like any false breakout that is not at a major extreme of a previous swing. You've got your swing failure, which is at a previous swing level. You have your multi-candle false breakout, which is just basically the multi-candle is probably the easiest one to initially identify because all you need is a confirmed breakout. So BOS, break of structure. That's easy to spot. You have consolidation, price breaks above, and it closes. So these are the ones where it does not immediately reject. then you just keep watching and you look for signs of weakness. There may be a bit of confusion in here as well because people use candle closes and people use candle wicks. I'll explain this better. So if you're explaining it from like how you would learn in bootcamp about market structure, BOS would be as soon as a candle closes above the highest candle close of the previous swing, that is considered to be a breakout. That's true. For the purpose of false breakouts though, it must also, so it's fine to say that's a BOS, that's true. Candle closes through it, that's fine. It must try and go above the liquidity, so the wick of the previous high, or low if it's the other way around. It must go above that before it goes back below. Why? Because something can't break out if it doesn't go beyond the extreme. So yes, a candle close, from a structural standpoint, candle closes can be used for market structure levels, for BOS. But in reality, price was here. Price went as high as 62,774. And so if price does not go beyond that, it doesn't trigger stops of people who put their stops at the highs. It doesn't trigger liquidations. It doesn't trigger breakout traders, at least, or as many of them. And so you wouldn't consider it a false breakout unless it tries to go above or below whichever extreme you're looking at. So just to be clear, you will use both candle closes and candle wicks in different contexts throughout your trading career. So just become accustomed to that. So that's swing failure, that's wick failure, that's multi-candle failure. Next, false breakouts can also be diagonal. This is really simple. This is where you can have trend line fail breaks, right? So I am not a big fan of trend lines. I don't really use them much, but I absolutely see their value. The value a trend line has is what other people interpret it to be. So I'm not a huge fan of trend lines because it's really, it introduces a lot of subjectivity because it's not horizontal. If you have a horizontal level, right, the weekly open is just the weekly open. It's whatever price horizontally we were at when the weekly candle opened. The lowest, the daily low, the weekly low, the monthly close, an order block, any of these objective levels are horizontal, so you can't deny where they are. They either are there or they're not. Yeah. The problem with trend lines, and again, I've got lessons on trend lines. There's no problem with them if you use them and you can use them profitably. More power to you. The problem with trend lines is where do you draw them? So I've picked out a couple that actually are pretty clean, and you'd be looking at it like this way. It's always good to go back on like replay mode for these. So this is a very clear trend line from wick to wick to wick. This is a super easy